What's up everybody, it's Alfonso, and welcome back to the channel. Today we're diving into how to invest smartly in 2026, because having a solid plan for your money is non-negotiable. Forget trying to time the market or chasing overnight riches. It's about being strategic, disciplined, and making informed decisions for long-term success. With new technologies, shifting policies, and global changes, 2026 will be full of both challenges and opportunities. The key? Position yourself to seize those opportunities while protecting your portfolio from unnecessary risks. I'll break down 6 essential practical stock market strategies, whether you're just starting out or managing a big portfolio. Remember to like and subscribe for more Money Smart Basics video. You have any suggestions for more financial videos, please leave a comment. Let's start with the foundation of smart investing. Diversification. This is the single most important principle that separates successful investors from those who take unnecessary risks and face big losses. You've probably heard the saying, don't put all your eggs in one basket. It's classic advice for a reason. If you bet everything on one company or sector, you're exposed to huge risk. One bad earnings report or market downturn could wipe out your gains in an instant. Instead, spread your investments across different sectors, like technology, healthcare, consumer goods, financials, and more. This way, if one sector struggles, others can help balance out your overall performance and keep your portfolio steady. Diversify geographically too. The US market is big, but international stocks and ETFs open you to global growth and reduce risk from any single economy. Markets around the world don't always move together, so global exposure can smooth out the bumps. The easiest way to achieve this broad diversification, use ETFs, or exchange-traded funds. They're simple, low cost, and give you access to a wide range of companies and regions with just a few clicks. For example, an S&P 500 ETF like VOO gives you instant access to hundreds of top US companies, spreading your risk across the biggest names in the market. Add an international ETF like VXUS for global exposure, so you're not just relying on the US economy. This helps you tap into growth in Europe, Asia, and emerging markets. Think of your portfolio as a fortress. Each asset class, sector, and region is a stone in the wall, making your defenses stronger. Don't forget about different asset classes either. Mix in some bonds for stability, especially if you're closer to retirement or want to reduce volatility. Bonds can act as a cushion when stocks are down. Find a balance that matches your risk tolerance and goals, maybe 90% stocks for younger investors with a long time horizon, or a more conservative split as you age and want to protect your wealth. Before your next investment, ask yourself, is your portfolio concentrated in just a few hot stocks, or is it a well-balanced mix that can weather any storm? Diversification isn't flashy, but it's your best defense against market surprises. It helps you sleep better at night, knowing you're not overexposed to any single risk. Make it your top priority for 2026. Put diversification at the very top of your financial checklist this year. Protect your capital and set yourself up for long-term growth. Don't gamble. Build wealth methodically, step by step, with a plan that stands the test of time. Review your portfolio regularly to maintain that balance. Markets change, and so should your allocations as your goals and life circumstances evolve. That's how you invest like a pro, by building a resilient, diversified portfolio that can thrive in any market environment. Next up, don't just diversify into quality. It's not enough to simply spread your investments around. You want to make sure you're putting your money into the best businesses out there. Invest in companies built to last, ones you'd hold for decades, not just for a quick gain. These are businesses with a proven track record, able to weather storms and come out stronger on the other side. Look for strong balance sheets, manageable debt, and consistent earnings growth. These financial fundamentals are the backbone of a resilient company, giving you confidence that your investment is secure. A quality company has a durable competitive advantage, a moat, like a trusted brand, patented tech, or a powerful network effect. These moats protect profits and keep competitors at bay, ensuring long-term success. These are the businesses people stick with, even in tough times. When the economy slows, customers still buy their products and services, making them reliable anchors in your portfolio. Think Apple, Coca-Cola, or Johnson & Johnson. companies embedded in daily life. Their products are everywhere, trusted by millions, and often the first choice for consumers worldwide. Do your homework. Read annual reports, listen to earnings calls, and understand what makes the business tick. Dig deep into their strategies, leadership, and long-term vision. Don't chase headlines or hype. Know why you're investing. Ignore the noise and focus on the facts that matter for the long run. This isn't about risky penny stocks or meme stocks. It's about being a disciplined, long-term business owner, committed to steady growth and real value. In 2026, with economic uncertainty, quality will matter more than ever. When markets get rough, strong companies stand tall while weaker ones falter. Blue-chip, cash-generating companies will reward patient investors. They pay dividends, reinvest in growth, and provide stability when you need it most. Fill your portfolio with these high-quality names. Over time, they'll help you ride out volatility and build a foundation for your financial future. It's the Warren Buffett way, and it works. Buffett's success is built on patience, discipline, and a relentless focus on quality. Be selective, be informed, and think like an owner. Treat every investment as if you're buying the whole business, not just a stock ticker. That's how you build lasting wealth, by owning pieces of great companies and letting time do the heavy lifting for you. Strategy 3. Consider dividend stocks. It's like getting paid to invest. Dividends are regular cash payments from companies to shareholders, a steady income stream, even when markets are rocky. Reinvesting dividends accelerates your wealth through compounding. In uncertain times, dividends provide a cushion and psychological boost. Companies that pay and grow dividends are usually financially strong and well managed. Look for dividend aristocrats, firms that have increased dividends for 25+ years. Don't chase the highest yields, focus on sustainable payouts and healthy companies. Avoid yield traps. Sometimes a high yield signals trouble. You can buy individual dividend stocks or use dividend-focused ETFs like SCHD or VIG for instant diversification. Use DRIP, dividend reinvestment plans, to automatically reinvest and grow your position. Over time, reinvested dividends can make up a huge part of your returns. For 2026, let dividends work quietly in your favor. It's a strategy that rewards patience and discipline. Strategy 4. Embrace technology and innovation for growth. In today's rapidly evolving world, staying ahead means adapting to new tools, trends, and breakthroughs that are shaping the future of business and investing. The world is changing fast, and companies driving the change can deliver massive returns. These are the businesses that are not just keeping up, but actually leading the charge into the future. Think beyond the big tech names. Look at AI, cloud computing, cybersecurity, and the digital infrastructure that supports our connected lives. Explore opportunities in renewable energy, biotech, and fintech. These sectors are transforming how we live, work, and manage our finances, offering new ways to invest in the future. Investing in innovation is betting on human progress. It's about supporting the ideas and technologies that will solve tomorrow's problems and create new markets. But remember, these stocks can be volatile. So, make this just a part of your diversified portfolio. Spreading your investments helps manage risk while still capturing growth. Use thematic ETFs to get exposure without taking on too much risk, like robotics, automation, or other cutting-edge sectors that are shaping the next decade. Consider funds focused on AI, clean energy, or other emerging technologies. These can give you broad access to innovative companies with a single investment. QQQ is a broader option, giving you access to top innovators across multiple industries, not just technology. Innovation isn't just in tech. Find it in healthcare, finance, and even industrials. Every sector is being transformed by new ideas and smarter solutions. Focus on companies investing heavily in R&D and growing their market share. These are the businesses most likely to disrupt their industries and deliver long-term growth. For these, look at revenue growth and potential, not just current profits. Early-stage innovators may not be profitable yet, but their future prospects can be huge. Dedicate 10–20% of your portfolio to these high-growth themes, depending on your risk tolerance and investment goals. This way, you can participate in the upside while managing your exposure. Balance is key. Anchor your portfolio with quality, stable investments, but don't miss out on future trends that could drive the next wave of returns. That's how you capture both stability and upside, positioning yourself for long-term success in a world driven by constant innovation. Strategy 5. Stay patient and avoid panic selling. The biggest mistake investors make is selling at the wrong time, especially during market drops. Corrections and bear markets are normal. They create buying opportunities for the patient. Look at any long-term chart. Crashes are just blips on the path upward. The winners are those who hold on or buy more when fear is highest. Adopt a long-term mindset. You're buying businesses for years, not weeks. Have a plan. Diversification and quality help you stay calm during downturns. Automate your investing with dollar-cost averaging. Buy regularly, no matter the market. Stop checking your portfolio every day. Review monthly or quarterly instead. Let your investments work while you live your life. In 2026, expect volatility and scary headlines. Remember, time in the market beats timing the market. Don't try to dodge every dip. Focus on staying invested. Trust your strategy, stay disciplined, and never panic sell. That's how you build real wealth. Final strategy. Never stop learning and regularly review your plan. The market changes, new tech emerges, and your life evolves, so your strategy should too. Stay informed, read investing books, follow reputable news, and watch educational content. The more you know, the more confident and less emotional you'll be. Review your portfolio at least once a year. Check if your investments still match your goals and risk tolerance. Ask, has your financial situation changed? Has your risk tolerance shifted? Are your companies still high quality? Rebalance if needed. Sell some winners, buy underperformers, and keep your target allocation. Continuous learning helps you spot new opportunities and avoid pitfalls. The best investors are always adapting and curious. Make this your overarching strategy for 2026 and beyond. Be a student of the game, review your plan, and adjust as needed. That's how you stay ahead in a changing world. Lifelong learning is your edge. There you have it, 6 powerful strategies to help you invest like a pro in 2026. Diversify across sectors and regions, focus on quality companies, harness the power of dividends, embrace innovation, stay patient, and keep learning. These steps create a robust framework for long-term wealth. Remember, investing is a marathon, not a sprint. The best time to start was yesterday, the second best is now. What are your top investing tips for 2026? Share in the comments. If you found value here, hit like, subscribe, and turn on notifications for more investing insights. Thanks for watching. See you in the next one. Years. The information provided in this content is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Always consult with a qualified financial advisor, tax professional, or legal counsel before making any financial decisions. The creator of this content is not responsible for any actions taken based on the information provided. Investments and financial decisions carry risk, and past performance does not guarantee future results.